Hello, welcome to the Capitalist Conversations. This is Karen Rands, and man, I'm supposed to be reading a disclaimer as well, right? So Eric isn't here today. He is out of town, and so I'm hosting, and I am going to give a disclaimer, even though it isn't the official one that he always reads. I don't have that right in front of me. I forgot. So the whole purpose of the compassionalist or the capitalist conversations is to help business owners and investors understand the sources of capital, the sources of creating wealth through an exit, through M&As and public offerings, and that whole process of capital and how it fuels our economy, how it fuels wealth creation on the entrepreneur side and the investor side, and understanding the flow of capital, what it is attracted to, how it is measured and delivered is integral to this ecosystem that we are creating. And so, to that end, let me just say this. Everything that I say here today is my opinion. It is based off of my experience in working with entrepreneurs and investors. You need to seek out counsel before making any legal decisions or investment decisions from experts that might be licensed in the area. Everything that we say and that we recommend is subject to your own discretion and your own accepting of the risk associated with that. So hopefully I did a good job on that. So my topic today is identifying the red flags in a business might limit its ability to succeed and therefore put any investor capital at risk. More risk than, say, other businesses that don't have those same red flags. And so if you have watched some of our sessions recently, I think last week we did like 3 weeks, we've done pitching investors and what needs to be in that. Eric did due diligence and the elements that he looks for in due diligence. And those were all part of the aspect of a company being prepared for capital. So whether a company is a startup company at the seed stage where they may not have all the elements of the due diligence, or they may not have all of the elements that can really create the roadmap of their success, they need to have a plan on how they're going to address the key elements that lead to their success, how the money that is going to be brought in are going to be used to address that. If they don't know what they don't know, that's a problem because they don't know it and they're not trying to solve it. So back when I ran the Network of Business Angels and Investors, and that was at the time when I was rebuilding it, it was one of the most successful angel investor groups in the Southeast, most active, and had made a national list of top 50. And so part of what I did, and this is similar to what, they may not follow this exact formula, but every angel investor group has some form of a screening process. Mine was much more specific because I wanted to give tangible action items to the entrepreneur to fix it. So if they did not qualify to present at the angel investor event, they would know what they needed to do in order to go forward in the future. And I still offer this service to entrepreneurs and companies at any stage so that ideally before they go to start raising capital, because it's really, really hard if you're an entrepreneur listening to go back to investors and say, oops, I said that I was this or that and I missed this and you didn't like it. Now I've got that fixed. You can, but most often investors are moving on. They have a constant drip of companies coming to them seeking capital. And so if there's an element of this red flag, or I have 8 areas that I look at, if there's an element of that is lacking, but there's a strategy, then coming back and saying, we have addressed that. Now are you interested? Now are you ready to move forward? That's a different conversation than not knowing what you don't know and being clueless, or doing it just all wrong, or in a lot of cases making mistakes that become a character flaw for that founder to that investor. That do they have the ability to actually make this thing happen? And there's this whole say of no trust buy. So they have to know that you're out there raising capital. Then they have to trust that you're going to do the things that you say you're going to do. And then they'll turn around and buy equity in your company and invest in you. And so I was doing this valuation before no trust buy became a thing, but that's really fundamentally what it's all about. So what are the key areas that I look for when I'm doing a business plan review? I call it a business plan review, but it's really investor preparedness. And I'm going to go through this and address it from an investor perspective and an entrepreneur perspective. So this is my list that I would use to identify the red flags when I review a business plan, a pitch deck, the executive summary, the business strategy, and financials that a company provided. And as I've said before, so the executive summary is the teaser. It should be a one-page document, maybe 2 pages if you have graphics, but it is a teaser. It is the highest level of information that you can provide to a prospective investor, and for an investor to be able to make a decision, yes, I want more information. This looks interesting. It's in the industry I'm interested in. It's solving a problem that I care about. It's at a stage that fits my criteria because, yeah, as we've talked in the past, there is a sort of a pipeline of funnel of funding, and it starts with individuals, friends and family, acquaintances, subjective investors, into angels, super angels, venture capital, then private equity and other institutional investments. Okay, so and there the criteria changes a little bit. The quality of information, the quality of or the results, the status changes along that pipeline, as well as Eric probably said, during the due diligence that's expected. So the first thing I look at is, and let me finish also saying, so the executive summary is this, and this is the first time that is it hitting some of these points? Are they indicating that they have information? They're not going to, because an executive summary is a summary, so they may only be one sentence, but does it indicate that they have a knowledge of that area, that it will be revealed in their business plan? Okay, so then to me, the financials are the next big thing that I look at. Like on an executive summary, you're going to only have top line, a profit line, maybe some cost of goods or cost of sales, some expenses that are the operational expenses, gross profit, net profit, that kind of a thing, right? And so the financials tell a story of how they made those numbers up, and do they have logical assumptions to achieve those numbers? I look at and I'll go into more detail on this, but to me, the numbers tell the story. And so then the business plan becomes a narrative of the numbers. It is how are those actually going to be achieved, or what research was done to justify the assumptions that were made. And then you look at the pitch deck. To me, is the visual representation of both of that, the business plan and the financials, with the strategy folded in. And so sometimes when I would do a business plan review, I would have a third party, like I learned this from IBM, a clean room, right? So they're not because sometimes when an entrepreneur is talking about their business, they'll give a lot of information, or they'll share a perspective of it, but they don't actually have it in a strategy. They don't know how they're going to do that. And so, certain sectors of the country, West Coast in particular, really they say they don't like business plans. But to me, the business plan is the blueprint. And a well-done business plan, there may be a summary business plan that's like 10 pages that they would share as part of their due diligence. And then there's a business plan that has sections in it that, as they build their team, they're going to give those sections to their team, because that's going to be that element, the marketing department, the human resources department, the operational and manufacturing, or the support, or whatever it is, the R&D department. It is, what is the roadmap of products? It's going to be their piece of the strategy that they are tasked to implement. And so to me, the business plan is part of that. So it's important to know that a company has that, because without something like that, my opinion, again, oftentimes an entrepreneur will be flying blind. They will be just churn and churn and churn and doing without really knowing if they are on track, or how do they need to adjust in order to reach the goals and the milestones that the investor expects. All right, so the first thing I look at is overall. So overall, in that context of those documents, do I understand their value proposition and their strategy? Almost like, could I boil it down to what you might call an elevator pitch? Can I say succinctly in a few sentences what's the problem that they're solving, how are they going to solve it, why they're uniquely qualified, and what is their strategy to execute on that? Right? If I can be clear in that in my head, then it's just really the rest of it is validating that and providing the meat on the bones. The overall value proposition strategy, clear and compelling, are the bones of the opportunity. All right. Then I look at accuracy and currency of what they are saying in their documents. And part of that is accuracy is if in their financial forecast, is it consistent with the numbers that are on the bottom of the executive summary? Is the information that's in the business plan or the pitch deck consistent throughout the documents? Or do they have, it's not that they've left something out, but they have a different strategy? Or currency, if they're basing some of their market expectations on data that are years old, the market, everything changes so rapidly. Any reference to a data point, unless it's specifically marketed as this is the historic and this is how it's changed over the last 10 years and this is where we are now and this is why the problem is still here, okay, then that is relevant. But otherwise, any stats that they have, anything needs to be within the last 2, maybe 3 years in particular. Like really, for example, we have major milestones in our economy. We're going through one right now. But COVID and a worldwide pandemic was really, it was devastating to a lot of businesses. How did they pivot and handle that? But status on market demand or market behavior or, any of that kind of stuff pre-2025 is really not relevant at all. I mean, in pre-2020 is not relevant in 2025. It really needs to be, it can be a pin of what dropped. And we had a client that I had to redo their presentation and their value proposition and their talking points. And one of the things that they had not emphasized in there was how they pivoted during COVID and thrived. That really sets them up to de-risk them raising capital now as we move forward in these treacherous economic times that we're faced with in our social political landscape, and what is going to happen, what's the impact of tariffs on businesses, and are they resilient, right? Or are they a new solution that's filling the gap because there is a lack of product or solutions or strategy for existing companies to navigate these treacherous times, right? So what is it? What is the point of what they were making? I was talking to a client, prospect yesterday, because I do these, free initial calls to sort of understand companies' businesses, and you can get access to that at my website, kugarand.com, kugarand.com. They kept referencing a behavior of trade shows, that when big companies collect data from trade shows, that's lead generation, they get it in a spreadsheet and it takes them months to respond to it. And I was like, is that really the way it is today? Because that's the way it was when I was at IBM over 20 years ago. And there's been no solution for any of the CRMs like Salesforce.com or HubSpot, a third party that feeds into that can easily converts that stuff. You really might want to double check your landscape and, understand and then also understand who's the real pain point, because it may not be the pain point of the trade show providers that do these QR code things and these scanners, because they don't care what they do with the data. They're just checking a box that you have a way of easily capturing all the people that come out of your booth, right? See, so that's a value proposition, part of that overall value proposition and strategy that, is part of my 20-minute call. Is it clear and compelling? And then, get into the other stuff. So the accuracy and currency, it becomes part of that on the market need. Where is the data coming from? How current is that data? That forecast and the documentation that does that. And if they are inconsistent in their numbers to an investor, so the investor out there, that says sloppiness, right? If the number one thing that a company needs to do right now is raise capital, to get where they need to go or to continue their operations, and they don't take a moment to reflect and review the content that they're providing to that investor, and it has clear errors in it. This also goes to sloppiness, like grammatical errors, disconnect because they've copied and pasted stuff that doesn't flow, just sloppiness in their documentation. You know what an investor does with it? And if you're an investor listening, it's okay to do this. Circular file. Do you know what that means? That means trash can. That means press delete. Service providers will respond back and say, hey, you need to fix this stuff. But, real investors, they're too busy looking at qualifying deals, narrowing down a large list of applicants or people asking for their response to whether they want to invest, to respond back to every company that comes to them. Particularly, I saw on LinkedIn yesterday that somebody that I guess I follow put up this list of 20 seed stage angel investors and the links to their profiles. Do you know how many requests those investors are going to get with that? I don't know if they gave him permission to do that or not. But to me, you've got to already have been, you can't go directly to that investor now. You have to start commenting, getting in their ecosystem, developing relationships with the people around them, figuring out what they invested in so that you can then approach them. Because investors get a lot of deals that they look at, and they only can say yes to so many. And there's not enough capital out there for all the qualified businesses, much less to spend time on the unqualified businesses. All right, so that was number 2, accuracy and currency. Number 3 is target market and marketing position. All right, so this is where you get into, do they really understand who their most authentic customer that is going to buy their product and willing to spend money on their product, right? Which kind of goes into my number 4, which is unique selling and value proposition. But first of all, it's the target market. So when you have a company that says their target market is like a really broad market, because maybe 18 to 40-year-olds will buy it. Or maybe I have this other company that I work with that I can't seem to get this point across, is that you can't provide a SaaS product that both small businesses and large businesses are going to use, because the pain point for each of those and the problem that they're solving is going to be different. And you may over time have a funnel that you're going to get to that where you go upstream on a customer base and you start with, but you've got to know, they have to know who their low-hanging fruit is. Who is the segment, the narrow segment that is going to be the most likely. So this is what they'll see: total addressable market, serviceable market, target market. They'll tailor down on this, and it's very popular in accelerators and incubators, and you'll see these charts that have these concentric circles. Is that what inside circles? And that's like, maybe that is sufficient. On a pitch deck, it's sufficient, but in a business plan, not sufficient. Need to have more tailored, like, why is it that they would buy? And how are you going to position yourself against your competition? How are you going to position yourself? And I'll address it more in the competition section, but if there is a situation where it is a new solution, well, then part of that is addressing why is somebody that is solving a company, an individual consumer that's solving the problem that they have right now, why are they going to try your product? So what is the pain point? And if it isn't clear and you're just creating demand and buzz for it, then it has to be that there is sufficient marketing strategy to get that message across to establish that no trust buy for their target market. Because keep in mind, when they're first entering the market, those customers, that target market, has no idea that they even exist. And there's a lot of noise in the marketplace. Speaking from my entrepreneur hat, I know this myself as I work hard, spend a lot of energy and money creating awareness of the ability for anybody to invest in entrepreneurs. And this is the pathway to go from a crowdfunding investor to an angel investor and maybe a solo VC. see is, here, this is the reason why you want to do it. And it's tough breaking through the noise, particularly when you have people with a lot bigger presence that, in my case, in my course case, all the people that are out there promoting real estate investing or stock market investing or crypto investing. That is my competition because I'm on a wealth creation strategy, a wealth empowerment, leaping the wealth gap for those individuals that have been excluded from the wealth creation of the traditional angel investor community. And so that, I understand that myself. So I look at it when I'm looking at companies and do they have an adequate strategy? Do they know how difficult it is? And that leads into their sales cycle, right? What is that sales cycle going to look like? What is that business model? Because every type of product has a different model associated with it and how somebody is going to discover and then become a buyer. Okay, so then that leads into number 4, unique selling value proposition. What is the specific problem that the company is solving and why are they uniquely constructed or positioned to solve that problem? What is that? What is that, right? And that should be something that is really clearly stated. Sometimes entrepreneurs will put this in as their mission statement or something like that. But it's, to me, a mission statement is sort of a personal kind of corporate culture kind of a thing. It's not really the meat, again, the meat on the bones of how are you going to fundamentally, that company going to fundamentally solve that need, that problem. So when that's like from a startup standpoint, but when you're a company that's been established, okay, for the companies that we are seeking to serve, Eric and I, through Sterling Holdings, through Coral Capital, through Mountain Share Transfer, the ecosystem that we're creating to use Reg A Plus and other crowdfunding direct public solicitations, direct public offerings to raise capital and provide liquidity to investors. And typically those are companies, and this is a lot of companies. There's a lot of companies out there that have raised angel capital and have gone into a plateau. And oftentimes is because of these red flags. They didn't understand their target market, their marketing positioning. They didn't have that stuff, right? And so they didn't raise enough capital. They overestimated how fast their revenue was going to come in because they really didn't understand their market. And so when a company is established and they've got millions of dollars in revenue, ample profit, but the profit has to keep going into their business to sustain and manage their regular growth, they struggle maybe to bring out a new product. Or they want to make an acquisition to address a gap in their product line or in the segment they're trying to solve, or they're going to pivot into a different segment. It could be a SaaS product that's solving a product in the healthcare arena, and maybe it can be pivoted to, a different element of the healthcare arena, or maybe it can be pivoted into decision processing for some other kind of industry, and they need to maybe make a strategic acquisition to be able to do that, or they want to bring manufacturing back into the United States and they need to be able to carry through, bring a new product out. They can get loans. I have access to the loans that they can get for their equipment, for their space, for their building, their facility, all of the hard dollar assets, but they need more capital than that to pay for the ramp up of people, to pay for the soft dollar of raw materials that they might be using, for the marketing collateral and the development of completing the market testing of that new product. And so we hybrid a combination of debt and equity into that strategy. And so when a company is looking at the unique selling proposition in this case, this is where we've been. So the historic is accurate history of where they've been and owning the reason why they have not scaled, because most investors want to know, well, you raised this capital and you didn't hit these milestones. What are you going to do different as you're going to get to this other? What are you going to do different with my money? I don't want to just put more fuel on the same old fire that isn't succeeding as it originally promised now. I want to see what's going to be different. And so unique selling and value proposition becomes part of that narrative narrative, part of that, this is what we're going to do with this new product. This is what we did on this. By adding this to our product line, we're going to be able to grow off of our existing customer base. We're going to be able to amplify our revenue. We're going to be able to compound our revenue. We're going to be able to add additional features that grows our recurring revenue on an annual basis. That part of what they're going to be doing with the use of funds, which I'll be talking to about in more. So number five is competition and barrier to entry. Okay, so competition is something that a lot of times entrepreneurs, and I see this again and again, and it will definitely be a reason why they struggle to raise capital. This company that I worked with for a good bit of time, I kept telling the founder that he was underestimating who his competition was, and anybody that really knew the industry knew that. And he could get small dollar investments because they were investing on emotion, but to get to the big dollar investments where you're getting into the very specific criteria of a business angel or a small VC or VC fund, he had to have a better handle on his competition. There were other things wrong as well, but the competition was a big part of it, and that is head to head, the target market. Different, in this particular case, it was an industrial product that solved a problem with, providing access to water and purification of water. And there's home-based solutions that are a consumer-based, and then there's industrial solutions that municipalities might use. And you can't do them all. And that's not your competition do it all. It goes to what I talked at the beginning. You may start small and then go bigger, but you can't do small business and big business. It has to be all of this stuff, right? And so it's very important for the entrepreneur and you as the investor to go. One of the simplest things I do this on a call when I'm doing my 20-minute thing. Who's your competition? And if they act like they don't have competition, then I just simply Google what it is that they're doing and say, who does this? And it comes up, right? Who does XYZ? And I'll get it. And if they say their competition is a certain thing, I'll pull up that company. And if it doesn't clearly say it on their website that they're doing what this company says that they're going to do, then they're not their competition. And what they're doing is trying to do kind of like a smoke and mirrors that says, this is my competition that I'm really good against because they don't have this. Well, guess what? They're not even trying to have it. The only way that that's a competition is if they have assessed that market opportunity isn't big enough to focus on it. All right. That ties into that target market. And do they really understand who the target market is? Because if their competition isn't doing something in that space and the company is making a better mousetrap for that or solving a problem in that way, then the best they can hope for is that competitor becomes an acquirer. And so I learned this lesson from one of my angel investors back in the day. It was a company that was filling a gap, and I forget which day. It might have been Oracle. I think it was Oracle. Oracle was not doing something in its relational database and its database services, and this company had created what was wedging into the marketplace, and that's a term that they should include in their strategy and things like that. We are wedging. How are you getting market share? We're wedging into the marketplace, right? It can't be 0.5% of this big market is going to be enough. How are they wedging into it? And so in wedging into that marketplace, there was a good opportunity, but how the company had put their valuation, where they were assessing, they were not providing that once we do this in Oracle, then we will be able to expand and go into this database or provide this small business solution for alternative to Oracle or any other kind of growth strategy. And after this investor spent a good bit of time meeting with the company because he was going to be an active angel. This is part of that, somebody that's investing their own money. He saw the deal through our pitch deck, and I had looked at it and said, yeah, there's definitely a need in this marketplace. There's definitely this, that, and the other thing, right? They got through the red flags and the screening process because they learned that, but I didn't understand this at the time, and I learned from this investor, is that based on that valuation, okay, this goes down into a point later, what's going to be the return on investment? And he said to me that their unique value proposition was strong and their competition would be Oracle could easily plug that gap. And the value that they were setting and the amount of money that he was about to put in, which was significant, he did not believe as the one pony horse, one horse pony, that was sufficient for him to get what he expected on his return on investment. I stayed in touch. They did raise some other capital. They got going and stuff, but it's easier, you've seen the model where Google and Microsoft and Amazon and Facebook or Meta, they all buy small companies that fill a gap. In some cases, they'll buy a company that is potentially a competitor to kill that business. We see Facebook going through that right now in their antitrust investigations. But it a lot of times is to capture more eyeballs, provide a service that they need, or something that they don't have right now that they can plug in and integrate with their business model. And that is a very logical, but they're not going to get to as big as they may forecast. That would be another kind of exit. Right. So understand that competition is really important in that segment, and the barrier to entry. So barrier to entry comes into what is their intellectual property? What are the strategic relationships they have? What are the things that they are doing that makes it harder for a competitor to come into that competition that's not just money? Okay. So you could see this with Uber and Lyft, various other things, or let's use Starbucks and local coffee houses, right? That they have a different value proposition because they're trying to be local and not the big box for that. But there's a different kind of value proposition for Starbucks. But you have, what was it, Seattle Coffee? What happened to them? So they are, and Lyft has been in this epic battle, between them, and trying to carve off and be separate. But oftentimes, almost everybody I know has both on their phones. And how they choose which one they use typically is which one's giving them the best price and is going to be the fastest pickup, which is, to how many drivers do they have, right? And the quality of the app, and then it goes into safety and these other things and stuff like that. So, that barrier to entry becomes a big part of that. And, too big to fail isn't true. That's never the case, right? And so, because there are always competitors trying to nip, IBM. Right? IBM's a great example of that. They've gone through some very dark times where they thought they were too big to fail, and they lost sight of their market opportunity, their unique value proposition, who their competition was, what was the barrier to entry, and they just assumed that these smaller guys couldn't compete. There wouldn't be a Compaq, there wouldn't be an Apple, there wouldn't be a Microsoft if IBM had, as a big company, actually understood that market. They ultimately bought Lotus, right, to fill a gap that they needed, right? And, so anyway, so number six is traction to date and the KPIs going forward. So the traction to date is, where are they? So as a seed stage company, it might be a working product that has these features and function, and this is where it's going to go. They've done some market validation. They've done a beta test. They've done alpha tests. They've done these kind of things. This is what they need to commercialize. This is their traction. This is how they're amplifying their marketplace, ideally like a one-on-many. Right? In my course, of course, I'm trying to sell my course directly to consumers and people that want to create the Compassionalist Academy. But I'm also working with affiliates. I'm working with organizations that have a large network of people that are success-oriented and wealth-oriented that would want this piece of financial literacy. And so I can achieve my goals and objectives that I have set, big, bodacious goals for the next couple of years of the impact that's going to have, ultimately to bring more capital into the market so more qualified entrepreneurs can be successful and more investors have contributed and felt good about the impact that their money is having because they can see that they're solving solutions in the marketplace that wouldn't be solved without their capital. And so, that is, so what is that, right? So like where I am right now, I don't have a lot of traction. And so I'm not a good investment right now. And so I don't ask for money because I know that. I'm trying to build that, right? But I have KPIs. What I expect and what I'm measuring, and those will be evolving. And so when it comes to entrepreneurs, where are they? Where are they going? How are they going to measure that they're on track? KPIs are key performance indicators. So, in public companies, those are going to be their ratios. What's the debt to income ratio? What's the utilization? Sometimes it's, what's their inventory turns? What's their exits of their churn of employees, right? Because there's soft dollar costs that a lot of times companies don't factor in to their profitability, or their lack of growing in profit is because they have a lot of employee churn. So it disrupts the momentum that the company can have in having a good team that's on mission to achieve the objectives. They're spending there's people not doing key tasks, or people that are overworked in their tasks and not getting things done in a timely manner because of the corporate culture, the corporate environment, the compensation, whatever that may be, but it directly impacts the bottom line. And so when those all become part of the traction deals directly with they're getting revenue in. What is their product getting to market, their efficiencies in getting their product to market, and their ability to convert leads into revenue. Okay, the KPIs are the measure of that, and then going forward, what does that look like for them to achieve these objectives? And so an established company, a company that might be raising $10 million under Reg A plus to match, $2 to $3 million they might be getting in SBA financing, it has to be a key part of that piece is these other types of ratios. I will be assessing that before I would represent a company to be able to go out to investors, because if I'm saying I'm working with this company, that means that I have validated that they have these elements and that they are de-risked, or we know that use of funds is going to come into that. So if they have a big churn, if they have a big problem hiring the right people, what does that look like on their compensation? And do they need to, they haven't done a pay raise, they haven't done bonuses in so long, they haven't done any profit sharing, they haven't done any stock sharing, providing stock incentives to their employees if they meet these objectives. If they don't have the cash, what are they doing to try to maintain loyalty? What are they doing to try to get employee feedback on how the difficulty it is to get their jobs done? Do they funnel up those problems on a semi-annual basis at the very least, that it's not just once a year? That what do we do this year? Because it's too late to pivot and address those things if they were only doing it once a year. So what is that? I would want to look at those kinds of things for a company that's established, and where are they going in their growth. This is like assessing where are they right now, what are the problems that are affecting their revenue. So even we look at collections, right? Are they able to collect their money? A big prominent company here, big company, a Fortune 500 company that a friend of mine works for, and she is in the business of collecting product revenue from their distribution channel and their customers. And if they have a program that says if they pay on time, they get like a 1%, 2% back. And so for big customers, that's a big deal, right? That's their profit, but they're basically gaining their own profit when they turn around and sell that product. And so she told me this about the difficulties they have in collecting sometimes because of an employee that was being illegal, fireable stuff, of changing the records of when their date was due. And they could track that this employee, because of their special circumstances, was not doing the work on a regular, consistent basis, and would have a flurry of activity at the end. And then when they did an audit, they figured out that this person was changing the stuff. And what did they end up doing at the end of the year? They just wrote that stuff off. If their shareholders knew how much money they're writing off as lost revenue because they couldn't carry it over in their books the next year, they would be stunned, right? It would be, some heads would roll on that. And so that And so as a private company, raising capital where there's still risk involved, I believe, and Eric and I believe, that it is our responsibility to assess that. Now, we have a team of people that are experts in these different areas that can help us, that we will bring in to do that for the investors out there that are listening, that might want to look for the companies that we're assisting, but also for those entrepreneurs that say, I really want to raise capital. Right now is a great time to position yourself to raise capital, because there is dry powder out there that needs to be put to work and has an opportunity to be put to work before all hell breaks loose in our economy, in our society, and everything else, right? We can put it to work, and we can fortify these companies so that they can succeed through this time and come out of it stronger, resilient, and with a return on investment for the investors, right? Because there are characteristics of how you can navigate that right now. So competition, that is traction day, KPIs going forward. All right, number 7, management team and advisory board, relevant experience and completeness. So for a startup, they're going to have a real limited management team, right? And sometimes they may be people that are who is available, may not be the best person for the job. And so does the CEO have the attitude, this kind of goes into coachability, that, and whoever they might be as their marketing person, does that marketing person have the right skills, or can they grow into the job for where they are right now? Do they have the right skills? Do they need to be augmented with an interim, like a chief marketing officer that can cultivate them and mentor them into that job, and the use of funds become part of that? Or do they have an advisory board where there's somebody that has that skills, that can direct, this is what manufacturing looks like, this is what you've got to do if this company, these founders have never manufactured anything before? Do they have somebody on their team? If it's a medical product, do they have somebody on their team that knows how to get FDA approval? That's, to me, such a fundamental thing. Or do they have, as part of their use of funds, to hire somebody with that? These are all part. So when I have my Entrepreneur Capital Mastery program, I go through this. What is your team? Where are the gaps? What is the strategy to do that? Because I believe that's such a critical part of being able to create a roadmap of how a company can scale and grow. And so when they're established and they're looking to go from making 10 widgets a week to 100 widgets a week, or they've got a new sign up of a SaaS product a month to 3 signups of a SaaS product a month, whatever that scale factor is, do they have the team to be able to execute that? Do they have the people that know how to scale that? Do they have a sales director that knows how to set the compensation, and how many sales reps do they have? And does that sales manager understand the funnel? Do they have, this ties into the KPIs, do they have the understanding of what their metrics need to be? Who needs to be at the top of the funnel in order to get to the, buy-in, to convert into, I want more information, to ultimately becoming a purchaser, right? And so and do they have the relevant experience, and how does it apply on that, and completeness? It's pretty straightforward on that. They, when it comes to the executive summary, might have just a list of names on the sidebar where you know nothing about them, but they might have a LinkedIn profile. I don't think you need to have lots of resumes on your stuff. It should be part of the due diligence, but they can just go to the LinkedIn profile. Now, the LinkedIn profile has to show the relevant experience. If it doesn't have the relevant experience, there needs to be something that explains how they bring something that's not in their public record. That would be relevant experience. All right. And so number 8, the investment structure or offer and the potential ROI, which includes the valuation. Goes to that story I told about the wedging of the company. So, that very often in early stage companies and startups, you have these safe notes, a simple agreement for future equity or convertible notes, right? That it's basically when we're not really sure what the value of this company is at this stage. There's not enough traction. There's not enough understanding of the true market yet, or the potential. We believe there is they understand their market, but we don't know. Sorry, I got something in my eye. That we don't know where they're going to be. So we believe that if they accomplish these things with this money, it'll create this type of value. So we're going to put a cap on what our value value, that value is going to be under a safe note, or it's going to convert in whatever the then value is when an institutional round of an angel network or something like that comes in. This also applies when you go back to existing investors in a company that needs to leap their life cycle. They plateaued and they need to get onto a new growth cycle. It can convert into that round of whatever that direct public offering is going to be, or institutional round that we might be helping them with. And so there's that part of it. And then it comes down to the valuation. So what and how many shares. So I see entrepreneurs make a mistake, particularly at the very early stage, at the startup stage, where they've created a high valuation because or two big mistakes, red flags. High valuation based on where they are, and that's because they've done some calculation on future value on a misdirected market segmentation, target market, or how big their market is, and then they maybe do a discounted net present value, but they kind of go, oh, we're a $20 million company. And it's because their simple forecast said that in 5 years they're going to have $20 million in revenue. But they can't back it up with their revenue strategy, their market strategy, or even their target market. And so when an investor comes in with $2 million, it's 10% of a $20 million company, and then post that is $22 million. And, you know, the problem with that is that company's going to have to raise a lot more money to get to the $20 million revenue as it is. And odds are it's going to take them longer than what they think it's going to take them. And so and they have to have a plan that says in order for that investor to be able to get their minimum return of 5 times their money, is that company has to be able to sell for $100 million, right? Or exit at that, so that value of 20 million is 5x. Therefore, that 2 million has gone up 5x. And if they don't have the strategy to that, then it's a non-starter. And it's better to raise smaller amounts over a period of time, or say, this is the total amount that we're going to need in order to achieve this $20 million. We're going to need $5 million. We're going to raise the first $2 million in a convertible or a safe, and then we're going to establish it outside at some kind of cap, you know, or some kind of discount to that, or they can do it in stages and tranches where the stock might go up in that in how much it gets. It's awkward to do that, but I've seen some companies do that. It's much better to just get it right. The other mistake that they make a lot of times is doing because secretaries of state don't know how many shares a company has. So maybe they establish a company with 100,000 shares. And I laugh because I've seen this. So each share is $10,000. I'm like, no investor is going to pay $10,000 for one share, unless they're an idiot. Buffett aside, right? Because I know his shares are a lot of money, but he's also got a different target market. He's got a whole different ball game. It's not a company that is having a value of this for their stock. Because what are they going to go public at? $100,000 a share? So they're at some point they're going to have to do a split or a quad split, right? And that costs money. So what amount of their $2 million they're raising are they going to allocate for the legal fees to change that share structure down to being something that can ultimately get them to a point of an exit? And sometimes entrepreneurs they're short-sighted in this. They sometimes will create a value or something, or put some kind of limit on things because they want to maintain control of their company. And they don't understand how you set up your corporate documents. I didn't talk about corporate documents, but it's something that you look at within this space of how they're offering. This is the offering. So what is the supermajority in their subscription agreement? Do they have common and preferred? So people can come into preferred that's set at one value, where common is set at a different value that they'll convert into, right? Or they're going to give sweeteners to the preferred investors of common. That, you know, we had a company that was one of my first major success cases of a company raising capital. They had raised money at a too high of a valuation. What they were offering was phenomenal, and the investors loved it, but they were not going to invest at their 20 million. And as we dug into it a little bit, the founder was like, you know, you're right, but he was going to go do a down round. And he had already raised $2 million on that valuation, and he was trying to raise $2 million more, and it was a medical product. So he had invested, a lot of doctors had invested because they saw the need for what he was doing without thinking about valuation, because they don't really think about that stuff. They're the subjective side of that initial piece of this kind of investment. I'd love to get some doctors into my course. Okay. But so anyway, they have, I ended up advising them on that worked quite successfully was that and it was an incentive that was time based that said anybody that invested in this round would get a kicker of common shares, an option to buy common shares at 50% of the value of what they were paying for on the preferred. Okay. So what happened was a whole bunch of their existing investors came in as well. And I had investors that were calling up. This is back in the day when we did fax machine stuff, calling up and saying, hey, I didn't, is it okay if I do this, if I get this stuff in and my money in by Monday? I'm not going to make the 5 o'clock Friday deadline. I was like, yes, of course, that's okay. Right. See, so it's understanding that. And I'll say one more thing on this. Unicorns. I have a sort of a thing. It's one of my personal pet peeve about unicorns, because I think so many unicorns are overvalued because they became a unicorn not because of their business model, their market opportunity, or their strategy to secure a significant revenue out of that market. It's because they had this meaty proposition that investors would come in. And so every time there was another round of investment that went in from 2 million to 10 million to 50 million to 100 million to 200 million, that all got added on. So now their post money valuation might be 300, 400 million, but they're still only doing 3 or 4 million in revenue. And so on the inside, on the covers, you might see how they're going to get to that point, but they become $1 billion valuation, not because of the same metrics that a public company is measured on when you look at their $1 billion market cap, because that's measured on how many shares are owned, how many investors, and what is the current price, right? And it fluctuates because that's a buying sell thing. More investors buying, the market cap goes up. More investors selling, market cap goes down. A lot of times independent of whatever their KPIs, revenue, ratios, any of that other kind of stuff. We've seen that a lot with great companies that have a major downfall because of the outside influences, because of the things that are happening on the worldwide stage, whether it's in America or otherwise, war in some place, a pandemic, a terrorist attack. These kind of things affect the market, and sometimes companies struggle to get more buyers buying it at that discounted now price, right? So this becomes part of this. Two different ways that you have to look at that. And unicorns are really troublesome because they have a struggle to get to that exit. And so in conclusion, what I do with this is then I look at this and I make a recommendation. Green light, they pass everything. This is never perfect, but what they're going to use the money for is going to directly address these needs, and therefore it is a good investment. The odds of them succeeding, separate for some outside black swan event, are good. Okay? Yellow is they have really good potential. They need to tweak this, that, or the other thing, these few things, and the use of funds will address that. They're going to hire this kind of a person. They're going to get they're going to hire this consultant. They're going to, outsource customer service, and, they're going to use this money to create all of their call scripts or something like that, right? To hire AI bots. They're going to implement AI in this way that's going to solve this internal problem so that they can make more revenue. And then red light are just, no, this company, either the company is off track, they don't truly understand there is the pain point, and the founder is not coachable to understand that. Another lesson I learned from investors that I apply in my thing, there's this company that I was like, wow, they had invented this technology that was would use there's a lightning signal that the weather response the weather system uses that, if it hits someplace, it will give a within like a 3-mile radius, that lightning's hit. That's how they know to get out of. Now you get warnings and things like that on your phone. But back when this was happening, it went through the utility companies, and went through alerts like public facilities to go inside, and there's lightning potential, golf courses and pools, and get out of the water, all that kind of stuff, baseball fields, all those kind of outdoor things. Right? But it also, they could pick it up, and they had designed this device that would turn off electronics, turn off your laptop, turn off your TV, turn off whatever you wanted in this. Back before we had Internet of Things and Bluetooth and a lot of this kind of stuff. So it was pretty revolutionary at the time. And they were selling to utility companies, to the electrical companies, to be something that they would provide to their business customers. And they were struggling to, and an investment banking firm, a broker dealer that I respected very much at the time, was representing them, which I thought was stunning that they were spending the money for this guy to represent them, given where they were in their product. But he had not picked up on that they were misdirected on who was the pain point. And so this one investor that was nearby where they were from. He was out of Jacksonville, would come to my Atlanta meetings. They were out of Savannah, and he came out of the telco space, so he understood the utilities and things like that. And he said they could care less. It does not hurt them, on the people that deliver the electricity, if a company gets their equipment fried, whatever their things that are electronically run fried, that they have to put an insurance claim. They're never going to implement this. Why would they implement this? I was like, that makes so much sense. And so I gave them that feedback, and they resisted it. They didn't really the founder was like, no, that's who it is, blah, 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 blah. Right? He was very adamant about it. But guess what? He didn't raise capital, or not enough capital, and he finally had to face the writing on the wall. So when they came to an event talking about their success of how they licensed their technology and then ultimately sell their technology to this company. And so it was APC, or whoever was the big surge protector, that saw this as a way for them to go from being just something in a wall for an individual device, like a small business owner, or every, that they could provide it on a larger scale for a small business that had multiple devices. They could put it into where mainframes were. They could put it into heated and air conditioned systems. They saw it as a solution to their problem. And so they first initially licensed it and just started with the small UPCs that you plug into your wall. And over time, they collaborated to develop it and the technology into these bigger things, and then ultimately bought the company. And they raised capital under that model. And that was like, oh, I always have to think through what the pain point is, right? So if a founder doesn't understand that, if they're an existing company that just wants to raise capital and they're not willing to assess why they have not scaled and be willing to address the problems that they have experienced and how they're going to solve them with this round of capital, as well as compound their revenue, bring out a whole nother revenue stream for that capital, accelerate their revenue, then they have a red flag. I'm not going to represent them, and I would advise any investor not to invest in them. And so with that is the story of the red flags. I hope that you have found something useful out of this talk as an investor, or as an entrepreneur, as a small business owner, or an institutional investor. And please go to the websites, coralcapital.com and cougaran.com if you want to set up an appointment with either Eric or myself, or hit us up on LinkedIn. And with that, onwards and upwards. Have a great day.